There is an invisible thief operating in the financial markets. It is silent, methodical, and relentlessly efficient. It doesn't trigger any alarms, it doesn't make the headlines, and most people willingly hand over their money to it every single day, often with a smile, believing they've just made a brilliant move. This thief is not a rogue trader or a corrupt executive. It's a feature of the system, a hidden tax embedded in the very structure of our financial world, and it preys on one of our most basic human instincts, the desire for action. Wall Street loves this thief. It thrives on the churn it creates, the commissions it generates, the sense of excitement and urgency it promotes. But Warren Buffett, the man who has built one of the world's greatest fortunes, declared war on this thief decades ago. He understood that building wealth isn't just about the profits you make, it's about the profits you keep. His entire philosophy, the bedrock of his nine-figure net worth, is built on a single powerful principle that is devastatingly simple yet almost universally ignored. It is the principle that your after-tax return is the only number that truly matters. He recognized that a dollar saved from taxes is far more valuable than a dollar earned in the market, because that saved dollar continues to work for you, compounding year after year in a silent, unstoppable march toward financial freedom. Most investors spend their lives focused on the hunt, chasing the thrill of a rising stock price, the dopamine hit of a successful trade. Buffett, however, mastered the art of the harvest. He engineered a strategy not just to grow his capital, but to protect it from the single biggest predator it would ever face, the tax code's bias against hyperactivity. This is not a story about finding the next hot stock. This is the story of a financial weapon, a legal and ethical strategy so potent that it has been the quiet engine behind the creation of hundreds of billions of dollars in value. It's a shift in mindset that will transform you from a market participant into a capital allocator, from a gambler into an owner. By the end of this journey, you will not only understand the hidden tax that has been silently siphoning away your portfolio growth, but you will possess the exact blueprint Warren Buffett has used for over half a century to nullify its power. You will learn that true wealth isn't built in the frenetic noise of daily trading, but in the disciplined, patient, and deliberate act of letting your capital compound in a fortress of tax efficiency. This is the final promise of investing, the one that separates good returns from generational wealth. Our journey begins with the most fundamental and overlooked force in investing, the brutal mathematics of tax drag. To understand Buffett's genius, you must first understand the enemy he dedicated his life to conquering. It's an enemy that hides in plain sight, disguised as profit. Before we delve into the grand stories and the complex psychology, we must first sit down with a simple calculator and stare into the abyss of what most investors willingly give away. This is the invisible thief laid bare, and its power is shocking. The core of this concept lies in the distinction the Internal Revenue Service makes between two types of profit: short-term capital gains and long-term capital gains. A short-term gain is the profit you make from selling an asset you've held for 1 year or less. A long-term gain is the profit from an asset held for more than 1 year. This 1 year and a day dividing line is arguably the single most important date on the financial calendar for an investor. Yet it is crossed with breathtaking indifference by millions every day. Short-term gains are taxed at your ordinary income tax rate. This means the profit from that stock you sold after 6 months is treated the same as the salary you earn from your job. For a high-income earner in the United States, this can mean a federal tax rate of 37% plus state taxes. In states like California or New York, the combined rate can push toward and even exceed 50%. Half of your hard-won profit vanished, sent to the government before you ever get a chance to use it. Long-term gains, however, are given preferential treatment. They are taxed at much lower rates, 0%, 15%, or 20%, depending on your income level. For the vast majority of investors, this rate is 15%. Think about that for a moment. By simply holding an asset for 1 day longer than a year, you can potentially cut your tax bill on the profits by more than half. This isn't a loophole, it's a deliberate feature of the tax code designed to encourage long-term investment over short-term speculation. And it is this simple, stark, mathematical difference that Warren Buffett has exploited with more discipline and on a larger scale than anyone in history. The foundational anecdote that truly cements this obsession with tax efficiency comes not from a billion-dollar deal, but from the humble beginnings of his investment partnership in the 1950s and 60s. In his famous partnership letters, written to a small group of investors, mostly family and friends, he wasn't just reporting returns, he was teaching. He was laying the foundation for a new way of thinking about wealth management. Imagine a young Warren Buffett, long before he was the Oracle of Omaha, sitting in his modest study, likely with a cherry Coke in hand, meticulously typing out a letter to his sister Doris. He would explain their partnership's performance, but he would obsess over the details that other money managers of the day completely ignored. He would write something to the effect of, "Doris, we had a gain of $20,000 in the Dempster Mill Manufacturing Company this year." Now the common response would be to sell, lock in that profit, and look for the next opportunity. But let's consider what happens the moment we sell. If we sell now, having held it for only 10 months, it is a short-term gain. Of that $20,000, roughly $8,000 will immediately be sent to the federal government as taxes. Our $20,000 profit is really only a $12,000 profit. But the damage doesn't stop there. That $8,000 we paid in taxes is now gone forever. It can no longer work for us, it cannot compound. If we were to leave that $8,000 invested alongside the rest of our capital, over the next 20 years, it could have grown into $80,000 or even $100,000 on its own. So the true cost of selling today isn't just the $8,000 in taxes, it's the future army of dollars that $8,000 would have created. However, if we simply wait another 2 months and 1 day, and the value remains the same, that $20,000 gain is now long-term. The tax would be closer to $3,000. By doing absolutely nothing, by demonstrating just a little patience, we not only save $5,000 today, but we preserve the compounding potential of that $5,000 for decades to come. Our goal is not to generate tax bills. Our goal is to own wonderful businesses. The tax bill is a sign of poor planning. This wasn't just a casual observation. It was the central operating principle of his entire enterprise. He saw taxes not as an expense to be paid, but as a permanent loss of compounding power. He treated every dollar paid in taxes as a tragic death in his army of capital, a soldier that could never again fight on the battlefield of investment returns. This deeply ingrained mindset, this obsession with after-tax returns, was his secret weapon from the very beginning. The underlying psychological principle that makes Buffett's approach so powerful and so rare is his complete mastery over 2 potent cognitive biases, myopic loss aversion and hyperbolic discounting. These 2 forces work in tandem to create the hyperactive, tax-inefficient investor that Wall Street preys upon. Myopic loss aversion, a concept detailed by economists Shlomo Benartzi and Richard Thaler, explains that we feel the pain of a loss about twice as much as we feel the pleasure of an equivalent gain. Furthermore, the more frequently we check our portfolios, the more likely we are to see small losses, experience that pain, and be tempted to do something, anything, to make it stop. This leads to a myopic or short-sighted view. We focus on the daily, weekly, or monthly fluctuations, which are essentially random noise, rather than the long-term signal of the underlying business's value. The trader who sees his stock drop 5% in a week feels the sting of loss and is tempted to sell to cut his losses, even if the company's 10-year outlook is fantastic. Conversely, if he sees a quick 20% gain, the fear of that gain disappearing, the fear of a future loss, prompts him to sell and lock it in. Both actions are driven by short-term emotional reactions to price movements, and both often lead to short-term capital gains taxes. Then comes hyperbolic discounting. This is our brain's tendency to prefer smaller, immediate rewards over larger, later rewards. We are wired for instant gratification. A guaranteed $100 today feels much better and is often chosen over a guaranteed $110 in a month. In investing, this manifests as an intense desire to realize a profit now. The tangible, immediate gratification of seeing that cash hit your account feels far more real and valuable than the abstract, larger future value of that same investment if left to compound tax-deferred for another 10 years. The short-term capital gains tax is a future problem, a problem for next April. The profit is a present reward. The brain, through hyperbolic discounting, systematically undervalues the long-term cost of the tax and overvalues the short-term benefit of the realized gain. Buffett's mind simply does not work this way. He has trained himself to invert this thinking. He feels the immediate, intense pain of $1 lost to taxes far more than the fleeting pleasure of a realized gain. He practices what could be called hyperbolic compounding, where the future, massive value of $1 left to compound tax-deferred is so vivid and real in his mind that it dwarfs the appeal of any immediate profit. He sidesteps myopic loss aversion by almost completely ignoring short-term price fluctuations, famously saying he wouldn't mind if the stock market closed for 10 years after he bought a business. He is not evaluating his portfolio, he is evaluating his ownership stake in a business. This psychological framing is his armor against the self-destructive impulses that plague the average retail investor. So how do we, as individual investors, apply this principle? We need a practical, step-by-step mental model. Let's call it the blueprint of the reluctant seller. It's a protocol you run before you ever hit the sell button, designed to force you to confront the true cost of your action and shift your perspective from short-term gains to long-term wealth management. Step 1. Identify the trigger. Before you do anything, you must honestly identify why you are considering a sale. Is it because the stock has gone up a lot and you feel euphoric? Is it because it has gone down and you feel fearful? Is it because you're bored and crave action? Or is it because the fundamental story of the business has permanently deteriorated? Be brutally honest. If the reason is emotional, fear, greed, or boredom, the protocol demands you stop immediately and wait a minimum of 7 days before reconsidering. This cooling off period is critical for letting the emotional wave pass. Step 2. Calculate the gross and net. If you pass the emotional trigger test and have a fundamental reason to sell, you must now do the math. Open a spreadsheet. In one cell, put the total profit you stand to make, the gross gain. Now, in the cell next to it, calculate the tax. Determine if it's short-term or long-term. Apply the correct percentage, be conservative, and use your highest marginal rate. This is your tax bill. In the third cell, subtract the tax bill from the gross gain. This is your net profit. Stare at the difference between the gross number you were so excited about and the net number you actually get to keep. This is the first dose of reality. Step 3. Project the tax ghost. This is the most crucial step, and the one that directly channels the Buffett mindset. Take the tax bill, the money you are about to voluntarily send to the government, and project its future value. Assume a conservative compound annual growth rate, say 8%. What would that tax money be worth in 10, 20, or 30 years if you had simply not sold and allowed it to remain invested? A $10,000 short-term tax bill today at 8% is a tax ghost that would have been worth over $46,000 in 20 years. By selling today, you are not just paying $10,000 in taxes. You are sacrificing the $46,000 it would have become. You are killing its future. This calculation transforms the abstract concept of tax drag into a tangible, painful number. It makes the long-term cost real and immediate, fighting back against hyperbolic discounting. Step 4. The reinvestment hurdle. Finally, you must identify the specific, new investment you plan to make with the net proceeds. The projected return on this new investment must be significantly higher than the one you are selling to justify the transaction. Why? Because you are not just starting over with a new investment. You are starting over with a smaller pile of capital because of the tax you just paid. And you have likely reset your cost basis to a higher level, reducing the potential for future tax-deferred gains. The new opportunity has to be so spectacularly good that it can overcome the headwind of the taxes you just paid and the loss of the compounding tax ghost. By running this simple 4-step blueprint, you fundamentally change the decision-making process. The default action is no longer to sell. The default action is to hold. Selling becomes an act of last resort, a decision made with full, sober knowledge of the immense cost, not just in today's dollars, but in the future wealth you are permanently sacrificing. This is the essence of building a tax planning framework into your core investment strategy. To truly appreciate the power of this blueprint, we must examine its opposite, the antithesis, or the path of the 99%. This is the world of the hyperactive trader, the market timer, the person who believes that success in investing is about constant activity. This path is paved with good intentions and terrible after-tax returns. Consider the story of Dave, a composite of countless retail investors from the last decade. Dave gets interested in the stock market. He opens a commission-free trading account, funds it with $50,000, and starts looking for opportunities. He reads headlines, follows market gurus on social media, and learns the basics of technical analysis. His strategy is to find stocks that are moving, ride the momentum for a 15 or 20% gain, and then sell to lock in the profit. In his first year, he's remarkably successful. He buys a tech stock and sells it 2 months later for a $5,000 profit. He buys a biotech stock and sells it 3 weeks later for a $4,000 gain. He jumps into a hot IPO and flips it for another $6,000. By the end of the year, his account statement shows that he has made 25 separate trades and has realized a total of $20,000 in gains. His initial $50,000 is now $70,000. He feels like a genius. He's beaten the market. He's on the fast track to financial freedom. He tells his friends about his success, boasting about his 40% pre-tax return. Then, in March of the following year, his accountant delivers the bad news. All $20,000 of his gains are short-term. Since Dave is in a 32% federal tax bracket and a 6% state tax bracket, his total tax rate on those gains is 38%. He owes $7,600 in taxes. His real after-tax profit was not $20,000, but $12,400. His actual after-tax return was not 40%, but a more modest 24.8%. Still not bad, he thinks. But the story gets worse. In his second year, the market is choppier. He has some wins, but also some losses. His constant trading generates another $15,000 in short-term gains, but he also racks up $5,000 in losses. He's allowed to deduct some of those losses, but the paperwork is a nightmare. He spends hours trying to sort out his cost basis for each of the dozens of trades he made. The stress is mounting. He's constantly checking his phone, his mood swinging with the market's daily whims. Meanwhile, his friend Sarah took a different approach. She also started with $50,000. She spent a month researching and bought a single, high-quality exchange-traded fund that tracks the S&P 500. Then she did nothing. For the entire 2 years, she never sold. The market had a good run, and her account is now also worth around $70,000. She has an unrealized gain of $20,000. Her tax bill? Zero. The full $70,000 remains in her account, working for her. If she were forced to sell today, her gain would be long-term, and her tax bill at a 15% rate would be just $3,000, less than half of what Dave paid on the same amount of profit. But she doesn't sell. She lets her army of capital continue to grow, fully intact, undecimated by the annual theft of taxes. Dave is playing a game of one step forward, half a step back. Each year, he gives away a huge chunk of his progress. Sarah is playing a game of pure compounding. Her progress is uninterrupted. Over a decade, this difference is not trivial. It is the entire ball game. Dave's portfolio might grow, but it will be a fraction of Sarah's, who harnessed the power of tax deferral. Dave's path is one of high stress, high effort, high fees. Even if commissions are free, there are bid-ask spreads and high taxes. It is the path of the 99%, a path that enriches brokers and the government far more than the investor. The direct financial connection of this principle is where the rubber meets the road. This isn't just a philosophical preference, it's a quantifiable, massive financial advantage that manifests directly in the growth trajectory of your portfolio. Let's model this out to see the staggering difference. Imagine two investors, Investor A, active trader, and Investor B, Buffett-style owner. Both start with $100,000. Both are skilled enough to generate a 15% pre-tax return every single year for 30 years. The only difference is their tax strategy. Investor A, the active trader, sells all his holdings at the end of each year to lock in his gains and reposition for the next year. This means his 15% gain is always short-term. We'll assume a combined federal and state short-term tax rate of 40%. Investor B, the owner, buys a portfolio of wonderful businesses and does not sell for the entire 30-year period. At the end of 30 years, he sells everything, and his entire gain is taxed at a long-term rate of 20%, a higher rate for a successful investor. Let's follow the money. In year one, both investors turn their $100,000 into $115,000, a gain of $15,000. Investor A sells. He pays 40% of his $15,000 gain in taxes, which is $6,000. He is left with $109,000 to reinvest for year two. Investor B sells nothing. His account is worth $115,000, and his full capital base goes into year two. The tax drag for Investor A has begun. In year two, Investor A's $109,000 grows by 15% to $125,350, a gain of $16,350. He pays 40% in tax, $6,540, and is left with $118,810. Investor B's $115,000 grows by 15% to $132,250. He pays zero tax. His full capital base remains intact. The gap is widening. Let's not go year by year, let's jump to the end of the 30-year period. Investor A's portfolio, despite generating a 15% pre-tax return, has an effective after-tax return of only 9%. 15%, 1 minus 0.40. His initial $100,000, compounding at 9% for 30 years, grows to $1,326,754. This is a fantastic result for most people, a clear path to a comfortable retirement. But now look at Investor B. His $100,000 compounds at the full 15% for 30 years because no taxes were ever taken out along the way. His portfolio grows to a staggering $6,621,177. Now at the very end, he sells everything. His cost basis was $100,000, so his gain is over $6.5 million. He pays his 20% long-term capital gains tax on this amount, which is approximately $1,304,000. His final after-tax net worth is $5,317,000. Let's compare the final numbers. Investor A, the active trader, ended with $1.3 million. Investor B, the Buffett-style owner, ended with $5.3 million. That is a four-fold difference, 4 times the wealth. They had the exact same starting capital and the exact same skill in picking investments. The only difference was their approach to tax efficiency. The tax drag for Investor A was a constant, vicious anchor, while Investor B sailed with the uninterrupted wind of pure pre-tax compounding at his back. This isn't a trick. This is the mathematical certainty that underpins Buffett's entire strategy. It's the clearest possible illustration of how a focus on after-tax returns is not just one part of a good investment strategy. It is the very foundation of building true generational wealth. This brings us to our second pillar, the living embodiment of this mathematical principle, the Coca-Cola Chronicle. If the first pillar was the theory, this is the proof. The story of Warren Buffett's investment in the Coca-Cola Company is perhaps the most famous and instructive example of his philosophy in action. It is a masterclass in patience, conviction, and, most importantly, the incredible power of using long-term investing as a financial weapon against taxes. To understand the genius of this investment, we must transport ourselves back to the late 1980s. The year is 1988. The financial world was still reeling from the shock of Black Monday, the catastrophic market crash of October 19, 1987, when the Dow Jones Industrial Average plummeted nearly 23% in a single day. Fear was palpable. Investors were terrified, convinced that another Great Depression was imminent. People were dumping stocks indiscriminately, desperate to flee to the perceived safety of cash. In this whirlwind of panic and pessimism, Warren Buffett was calm. He was not looking at the squiggly lines on a chart. He was looking for bargains on pieces of American enterprise. He saw the crash not as a disaster, but as an opportunity to buy wonderful businesses at fair prices. And the business that caught his eye was Coca-Cola. At the time, Coke was facing some headwinds. There was the infamous New Coke debacle of 1985, a marketing blunder of epic proportions that had temporarily tarnished its reputation. The market was also worried about slowing growth and increased competition. But Buffett saw something different. He saw a business with one of the most powerful brands on the planet. He saw a simple product that was sold in nearly every country, a product that induced happiness and cost very little. He saw a business with a commanding distribution network, a global moat that was virtually unassailable. He saw a company that could raise its prices just a little bit each year without losing customers, giving it incredible pricing power. He flew to Atlanta, met with the management, and drank a lot of cherry Coke. He wasn't just analyzing numbers, he was analyzing the enduring nature of the business itself. So, between 1988 and 1989, while others were still licking their wounds from the crash, Berkshire Hathaway began to buy Coca-Cola stock. And it didn't just nibble, it gorged. Over a period of several months, Buffett invested approximately $1.3 billion, accumulating a massive position that would eventually represent over 6% of the entire company. This was an enormous bet. Even for him, it was a bold, decisive move based on his conviction in the long-term value of the business. The market was skeptical. Many analysts thought he was overpaying for a mature, slow-growth company. But Buffett wasn't buying the stock for a one-year pop. He was buying a permanent piece of a global powerhouse. And then he did the most radical thing of all: absolutely nothing. For over 3 decades since that initial purchase, Berkshire Hathaway has not sold a single share of its Coca-Cola stock. Think of the discipline that requires. The stock has gone through periods of incredible growth, periods of stagnation, market bubbles, and market crashes. It has split its shares multiple times. There were countless moments when a prudent money manager would have been tempted to trim the position, or rebalance, or take some profits off the table. Buffett resisted every single one of those impulses. He viewed Berkshire's stake in Coca-Cola not as a stock ticker, but as a silent partnership and a gusher of cash flow. He was an owner. And as long as the fundamental story of the business remained intact, people around the world still wanting a simple, affordable, happy drink, there was no reason to sell. By refusing to sell, he avoided triggering a colossal capital gains tax event. The $1.3 billion he invested has, at times, been worth over $25 billion. A sale would have resulted in a tax bill of billions of dollars, instantly vaporizing a huge chunk of his shareholders' wealth. That tax money, instead of being sent to Washington, D.C., was left inside the investment, continuing to compound, continuing to work for Berkshire's owners. Furthermore, Coca-Cola is a dividend-paying company. Every year, for over 30 years, it has sent a massive check to Omaha. That dividend has grown steadily over time. Today, the annual dividend that Berkshire Hathaway receives from Coca-Cola is over $700 million. To put that in perspective, Buffett's company now receives more than 50% of its original $1.3 billion investment back in cash every single year without having to sell a single share. This is the ultimate payoff of long-term investing. The initial investment has not only grown exponentially in value, tax-deferred, but it has also transformed into a perpetual cash flow machine. The Coca-Cola Chronicle is the perfect foundational anecdote because it's not about a clever trade, it's about a profound business decision. It's the ultimate demonstration of patience as a strategic, tax-efficient weapon, and it laid the groundwork for a portfolio growth strategy that would become the envy of the financial world. The psychological principle that allowed Buffett to hold Coca-Cola for over 30 years, through thick and thin, can be understood as a constructive application of the endowment effect. The endowment effect, a term coined by economist Richard Thaler, describes our tendency to place a higher value on something simply because we own it. If you give someone a coffee mug and then offer to buy it back, they will typically demand a much higher price than they would have been willing to pay for it in the first place. Ownership creates an emotional attachment that inflates our perception of value. For most investors, this bias can be dangerous. It can cause them to hold on to losing stocks for far too long, unwilling to admit a mistake because they own it. They fall in love with their losers. But Buffett, in his characteristic way, flips this bias on its head and turns it into a superpower. He doesn't fall in love with the stock. He develops a deep and profound sense of ownership over the underlying business. When he bought Coca-Cola, he didn't see himself as owning a stock certificate with the ticker symbol KO. He saw himself as a silent partner with a 6% stake in a global beverage empire. This sense of proprietorship is a much deeper, more resilient form of the endowment effect. It's not an irrational attachment to a price on a screen. It's a rational commitment to a business whose fundamentals he understands intimately. This ownership mindset fundamentally changes his relationship with market volatility. When the price of Coca-Cola stock drops, he doesn't feel the panic of a stock trader watching his position shrink. He feels the excitement of a business owner who might get the chance to buy more of his favorite business at a discount. He once famously said, "If you plan to eat hamburgers throughout your life and are not a cattle producer, should you wish for higher or lower prices for beef?" He applies the same logic to stocks of companies he wants to own for the long term. This perspective makes him immune to the panic selling that the endowment effect can cause in others when they see their cherished possession lose value. Conversely, when the stock price soars, he doesn't get the urge to sell and cash in. A true business owner doesn't sell his profitable, growing business just because someone offers him a high price for it one day. He holds on to it, nurturing it, and enjoying the cash flow it produces. This constructive endowment effect, this deep-seated identity as a business proprietor, serves as a powerful psychological barrier against the temptation of short-term trading. It provides the emotional fortitude required for true, long-term investing. It's the mental software that allows him to execute his tax-efficient strategy with unwavering discipline for decades, transforming a cognitive bias that cripples most investors into a cornerstone of his success in building wealth. To operationalize this principle, we can create a mental model called the Forever Hold Litmus Test. This is a rigorous checklist, a gauntlet that any potential investment must run before you even consider buying it. Its purpose is to force you into the mindset of a permanent owner, not a temporary renter of a stock. Passing this test is the first step toward building a portfolio that is naturally tax efficient, because it will be composed of businesses you are psychologically prepared to hold for a very, very long time. The test consists of 5 key questions. Question 1. The 10-year shutdown. Ask yourself, if the stock market were to close for the next 10 years, starting the day after I buy this stock, would I be comfortable and confident owning this business? This question immediately eliminates 99% of speculative trades. It forces you to look past the short-term price action and focus entirely on the durability and earning power of the underlying business. You have to have faith in the company's management, its competitive position, and its industry's future, because you won't be able to sell no matter what happens. If the thought of being locked into an investment for a decade terrifies you, you haven't found a forever hold candidate. Question 2. The moat durability query. Can I clearly and simply explain this company's competitive advantage? or moat, and can I articulate why that advantage will still be intact, or even stronger, a decade from now? A wide moat is what protects a business's profits from competitors. It could be a powerful brand like Coca-Cola, a low-cost process like Geico, or a network effect like American Express. If you can't explain the moat in a simple sentence, you don't understand the investment well enough. True long-term investing requires conviction, and conviction is born from deep understanding. Question 3. The Drawdown Gauntlet. Am I mentally prepared to watch this stock fall by 50% without panic selling? Every great company, at some point in its history, has seen its stock price get cut in half. Amazon during the dot-com bust, Apple in 2013, Coca-Cola in 1998. Volatility is the price of admission for long-term returns. If your conviction in the business is not strong enough to hold on, or even buy more, during a period of intense market panic, you are destined to sell at the worst possible time, locking in losses and failing the long-term test. This question probes the depth of your psychological resolve. Question 4. The Earnings Yield Test. If the stock price went nowhere for the next 5 years, would I be satisfied with the company's earnings yield as my return? The earnings yield is the inverse of the price-to-earnings ratio. It represents the profit the business generates per share, divided by the price you paid for that share. Thinking this way reframes the goal from hoping the stock goes up to owning a piece of a profitable enterprise. A business with a solid and growing earnings yield is a worthwhile investment, even if its stock price stagnates for a while, because the underlying value is still compounding. This is a core component of any CEO mindset focused on real business performance, not just market sentiment. Question 5. The Never Sell Memo. Before you buy, you must write a short memo outlining the specific conditions under which you would sell. These conditions should have nothing to do with the stock price. They should be related to the fundamental business. For example, I will sell my shares in this company if its primary competitive advantage is permanently eroded by a new technology. Or, I will sell if a new management team consistently demonstrates poor capital allocation decisions. Having these pre-committed sell criteria written down in advance acts as a contract with your future, more emotional self. It prevents you from selling out of fear or greed and ensures you only sell for rational, business-focused reasons. By subjecting every potential investment to this 5-question litmus test, you radically change your approach to how to invest. You cease to be a stock picker and become a business analyst. You build a portfolio not of tickers but of partnerships. And as a natural byproduct, you create a structure that is inherently tax efficient because it is built from the ground up for long-term ownership, allowing your portfolio growth to be supercharged by the power of uninterrupted compounding. To fully grasp the wisdom of the Forever Hold litmus test, we must explore its dark reflection, the antithesis, the path of the profit snatcher. This is the investor who sees a gain on their screen and is overcome by an irresistible urge to convert that virtual number into real cash. They are not owners, they are opportunists, and their short-sightedness costs them a fortune in taxes and, more tragically, in opportunity. Let's tell the story of the investor who bought Apple in 2004. This person, let's call him Tom, was ahead of the curve. He saw the success of the iPod and the iMac. He read about Steve Jobs' vision for the digital hub. He bought 1,000 shares of Apple at a split-adjusted price of about $1.50 per share. His total investment was $1,500. He was a visionary. For the next 2 years, he watched in delight as Apple released the iPod Nano, the video iPod, and continued its meteoric rise. By 2006, the stock had risen to about $7.50 per share. His initial $1,500 investment was now worth $7,500. He had a gain of $6,000, a 400% return in 2 years. He felt brilliant. His friends were amazed. But then the fear kicked in, the fear of losing that beautiful gain. You can't go broke taking a profit, his uncle always said. So he sold all 1,000 shares. He locked in his $6,000 profit. Since he had held the stock for more than a year, it was a long-term capital gain. He paid a 15% tax, which was $900. His net profit was $5,100. He took his family on a nice vacation. He felt smart, prudent, and successful. He had successfully timed his exit. But what did Tom actually sell? He didn't just sell a stock. He sold his share of the most profitable decade any company has ever had in the history of capitalism. He sold his stake just before the launch of the iPhone in 2007, the App Store in 2008, the iPad in 2010, and the Apple Watch in 2015. He sold his claim on hundreds of billions of dollars in future profits. Today, those 1,000 shares adjusted for subsequent stock splits would be 28,000 shares. At a price of, say, $170 per share, Tom's stake would be worth $4,760,000. By selling early to lock in a $6,000 gain, he forfeited a $4.7 million fortune. The $900 in taxes he paid was not the real cost. The real cost was the staggering opportunity cost of abandoning a winning horse in the first lap of the race. The profit snatcher mentality is a trap. It feels good in the short term, providing a small hit of gratification and a sense of control, but it is a catastrophic long-term investment strategy. It systematically forces you to sell your biggest winners, the very companies that are supposed to drive your long-term returns, far too early. And each time you do it, you pay a tax, a frictional cost, that reduces the capital you have available to find the next big winner, which is an incredibly difficult task to begin with. The Buffett approach, as demonstrated with Coca-Cola, is the exact opposite. He understands that winning in the stock market is a lot like baseball. The key is not to hit a lot of singles. The key is to occasionally hit a grand slam and then make sure you run all the bases. Selling a great company after it doubles or triples is like hitting a home run and stopping at first base to celebrate. It's a failure of imagination and a costly misunderstanding of how true generational wealth is built. The direct financial connection of holding a wonderful business like Coca-Cola for decades is almost impossible to overstate. It's a strategy that fundamentally alters the financial DNA of a portfolio, creating wealth on multiple fronts simultaneously. Let's break down the tangible financial advantages Berkshire Hathaway has enjoyed from this single decision. First, and most obviously, is the massive tax deferral. As we discussed, Buffett's $1.3 billion investment has grown to be worth over $25 billion. The unrealized gain is therefore around $23.7 billion. If Berkshire were to sell this position today, it would face a corporate capital gains tax. Let's assume a rate of 21%. The tax bill would be approximately $5 billion. That is $5 billion that, by simply not selling, remains under Berkshire's control. It is part of the company's net worth, part of its book value, and it contributes to the fortress-like balance sheet that allows Buffett to make other massive investments. This $5 billion is not idle. It is a ghost army working in the background, generating returns. Second is the power of compounding on a pre-tax sum. This is the concept we modeled earlier, but the Coca-Cola story makes it real. For over 30 years, the full pre-tax value of Berkshire's investment has been allowed to grow. The $5 billion in deferred taxes was not siphoned off. It was part of the capital base that grew from $1.3 billion to $25 billion. If that tax had been paid along the way through trimming the position, the final value would be significantly lower. The engine of portfolio growth was allowed to run at full power, without the constant friction of tax drag. Third is the incredible dividend yield on cost. This is a concept that long-term investors cherish. Buffett invested $1.3 billion. Today, Berkshire receives over $700 million in annual dividends from Coca-Cola. The yield on cost is therefore $700 million divided by $1.3 billion, which is a staggering 54%. This means that every 2 years, Berkshire gets its entire original investment back in cash, and it still owns the entire stake. This fire hose of cash can then be redeployed into other investments, buying other businesses, without having to sell the original asset. It turns a one-time investment into a perpetual funding machine. This is a direct result of holding for decades, while the underlying company consistently grew its dividend payout. A short-term trader would never experience this phenomenon. Fourth is the strategic value of the asset on the balance sheet. A massive, liquid, and stable holding like Coca-Cola stock is a significant asset that enhances Berkshire's financial strength. It can be used as collateral for loans if needed, though Berkshire rarely needs to borrow. It provides a level of financial security and flexibility that allows Buffett to be bold during market downturns, using that very strength to acquire other assets at distressed prices. The holding is not just a number in a brokerage account, it's a strategic pillar of the entire Berkshire Hathaway enterprise. The Coca-Cola Chronicle is therefore the ultimate case study in how a long-term investing philosophy translates into direct, quantifiable, and multifaceted financial advantage. It demonstrates how tax efficiency is not a passive benefit but an active driver of superior after-tax returns, transforming a great investment into a legendary one. We've explored the math of tax drag and the power of patient ownership. Now we must confront the enemy within. Pillar 3 is about the deep-seated psychological forces that make the first two pillars so difficult to implement. It's about the brain's betrayal, the cognitive wiring that screams at us to do something when the optimal course of action is almost always to do nothing. This is the battle against the action bias. The action bias is the innate human tendency to favor action over inaction, even when evidence suggests that inaction is the more rational choice. In our evolutionary past, this made sense. If you heard a rustle in the bushes, it was better to throw a spear or run away, action, than to sit still and analyze the situation, inaction. The cost of a false positive, acting when there was no danger, was low, while the cost of a false negative, doing nothing when a predator was present, was catastrophic. Our brains are therefore hardwired with a simple mantra: don't just stand there, do something. In the modern world of investing, this instinct is a profound liability. The stock market is the rustling bush, and our brain tells us to react to every noise, every flicker of red or green on the screen. The constant stream of financial news, expert predictions, and price alerts creates an illusion of urgency. It makes us feel that if we are not actively trading, rebalancing, or repositioning, we are being negligent. We feel we are falling behind. Doing nothing feels like laziness or incompetence. Taking action, on the other hand, gives us a sense of control. Hitting the buy or sell button is a tangible act. It provides a dopamine hit, a small reward that reinforces the behavior. We feel like we are piloting our financial destiny, even if we are just reacting to random market noise. This is the great illusion that powers the entire financial industry. Wall Street is a monument to the action bias. It thrives on activity, on commissions, on advisory fees for active management, on the narrative that you need to be constantly engaged to succeed. Warren Buffett's entire career can be viewed as one long, disciplined rebellion against the action bias. His genius lies not just in what he buys, but in what he doesn't do. He is the master of intelligent inaction. A foundational anecdote that perfectly illustrates this mastery over the action bias is not a story of a brilliant purchase, but a story of a long, and for many, frustrating period of inactivity. We must look to the years following the spectacular collapse of the dot-com bubble. From 2000 to 2002, the Nasdaq index, filled with technology and internet companies, fell by nearly 80%. The market was a bloodbath. Companies that were worth billions one day were bankrupt the next. After the crash, many investors saw a landscape of opportunity. Stocks were on sale. The talking heads on television were shouting about once-in-a-generation buying opportunities. The pressure to act, to go bargain hunting amidst the wreckage, was immense. And what was Warren Buffett doing? He was sitting. He sat on a mountain of cash, a cash hoard that grew to tens of billions of dollars. Year after year, he wrote in his annual letters that he could find nothing to buy that met his stringent criteria of a wonderful business at a sensible price. He was mocked by many in the financial press. They called him old, out of touch. They said he didn't get technology. They claimed the game had passed him by. The pressure from his own shareholders to put the cash to work was enormous. Cash, after all, was earning a paltry interest rate, while the market was slowly starting to recover. The action bias was screaming at him from every direction. But Buffett remained completely unmoved. He famously described his investing approach using a baseball analogy. The trick in investing is to just sit there and watch pitch after pitch go by and wait for the one that's in your sweet spot. And if people are yelling, "Swing, you bum," ignore them. From late 1999 through 2003, Buffett made very few significant investments. He was watching pitches go by. He had the discipline to do nothing to let the cash pile up, even if it meant underperforming the market for a short period. He understood that the sin of commission, making a bad investment, was far worse than the sin of omission, missing out on a mediocre one. He was waiting for the perfect pitch, the fat pitch, the no-brainer deal. He did not feel the need to swing just for the sake of swinging. This period of lethargy, as he might call it, was not a sign of weakness. It was a sign of immense psychological strength. It was the action bias being held in a chokehold by pure, unadulterated discipline. It is a far less glamorous story than the purchase of Coca-Cola, but it is arguably more instructive. It teaches us that successful investing is not about constant motion. It is about long periods of study and patience, punctuated by brief moments of decisive action when the odds are overwhelmingly in your favor. Resisting the urge to act is a superpower, and it is a muscle that must be trained. It is also, not coincidentally, the bedrock of a tax-efficient strategy, as the refusal to act prevents the constant buying and selling that generates tax liabilities. The psychological principle we must conquer to emulate Buffett's patience is not just the action bias but its close cousin, the illusion of control. This is a cognitive bias where people overestimate their ability to control events. In investing, it manifests as the belief that through more research, more trading, and more sophisticated tools, we can outsmart the market and control our investment outcomes. The constant stream of data, charts, and news feeds into this illusion. It makes us feel that if we just process enough information, we can predict the future. The act of trading is the ultimate expression of this illusion. When we place a trade, we are making an implicit statement. I know something the market doesn't. I know this stock is going up, or this one is going down. This feeling is intoxicating. It transforms the investor from a passive participant into an active protagonist. However, for the vast majority of people, this sense of control is entirely false. Short-term market movements are notoriously unpredictable. By trading frequently, we are not demonstrating control. We are merely exposing ourselves to randomness, while guaranteeing frictional costs like bid-ask spreads and, of course, taxes. Buffett's antidote to the illusion of control is a deep and profound sense of intellectual humility. He readily admits that he cannot predict what the stock market will do next week, next month, or next year. He doesn't know what the economy will do. He doesn't try to time the market. This admission is incredibly liberating. By abandoning any attempt to control the uncontrollable short-term market prices, he is free to focus all of his energy on the few things he can control. What can he control? He can control which businesses he chooses to partner with. He can control the price he is willing to pay for those businesses. He can control his own behavior, his own emotional reactions to market volatility. And he can control his holding period, thereby controlling his exposure to capital gains taxes. His entire investment philosophy is an exercise in focusing on a small number of important, controllable variables, while completely ignoring the infinite number of uncontrollable ones. This is a radical departure from the mindset of the typical retail investor, who is obsessed with the uncontrollable, where is the market heading, and spends very little time on the controllable. Is this a business I understand and want to own for a decade? Overcoming the illusion of control requires a conscious shift. It requires accepting that the market is a chaotic system and that our ability to predict its short-term path is virtually zero. It means embracing inaction not as a failure, but as a strategic choice. It means having the humility to say, "I don't know," and the wisdom to understand that in investing, that is often the most powerful statement one can make. To install this discipline into our own financial lives, we need a practical blueprint. Let's call it the Forced Inactivity Protocol. This is a set of personal rules designed to create friction between an impulse and an action, giving your rational brain time to intervene. It's a commitment to a system that makes it harder to act and easier to stay the course. The protocol has three main components. First, the portfolio quarantine. For the first year after you buy a new stock that has passed the forever hold litmus test, that position is in quote, 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 quote. You are programmatically forbidden from selling it, barring one of the pre-committed fundamental reasons you wrote down in your memo. This one-year quarantine has a powerful dual effect. Psychologically, it forces you to think like a long-term owner from day one. You know you're in it for at least a year, so you stop worrying about daily price swings. Financially, it guarantees that if you do end up selling after the quarantine, any gain will automatically be classified as long-term, securing the lower tax rate. This simple rule instantly eliminates the possibility of generating short-term capital gains from new investments. Second, the 72-hour memo rule. If you are considering any action, buying or selling, outside of your regular pre-planned contributions, you must first write a one-page memo to yourself. The memo must clearly state the thesis for the action. Why are you buying this specific company now? Or, why has the long-term thesis for a company you own been permanently broken? You are not allowed to execute the trade until 72 hours have passed since the completion of the memo. This cooling-off period is designed to be a circuit breaker for emotional decisions. The urge to panic sell during a crash or FOMO buy during a bubble is an intense, short-lived emotional storm. The 72-hour rule forces you to wait until the storm has passed and you can reread your memo with a clearer head. In most cases, you'll find that the urgency has vanished and the original thesis for holding remains intact. Third, the information diet. You must consciously limit your consumption of short-term market information. This means deleting the stock market app from your phone's home screen. It means turning off breaking news alerts from financial media. It means limiting yourself to checking your portfolio to once a week or even once a month. The constant stream of information is the fuel for the action bias. By cutting off the fuel supply, you reduce the number of impulses you have to fight. Buffett doesn't sit with a screen of flashing stock quotes all day. He sits in his office and reads annual reports, books, and industry journals. He is focused on the long-term signal, not the short-term noise. By adopting this information diet, you are choosing to do the same. This forced inactivity protocol is not about being passive or uninformed. It's about being deliberate. It is a system of rules you create during a time of calm to protect yourself from the irrational decisions your brain is likely to make during a time of stress. It is the practical application of Buffett's discipline, a way to hardwire a CEO mindset of patience and intelligent inaction into your investment strategy. The antithesis to this disciplined inaction is the frenetic and ultimately tragic world of the hyperactive day trader, a phenomenon that reached a fever pitch in recent years. This is the path of the 99%, supercharged by technology and social media, and it serves as a stark warning. Let's consider the story of Kevin, a young man who got swept up in the meme stock craze. In early 2021, armed with a commission-free trading app and a small stimulus check, Kevin dove into the world of online trading forums. He wasn't interested in balance sheets or competitive moats. He was interested in stonks, in rockets, in diamond hands, and tendies. He saw stories of people turning a few $1,000s into hundreds of thousands in a matter of weeks by betting on heavily shorted stocks. The action bias was not just a bias for Kevin, it was the entire game. The goal was to trade, to be part of the movement, to feel the thrill of battle against hedge funds. He bought a popular meme stock, watched it soar 300% in 2 days, and sold, making a quick $10,000 profit. The dopamine rush was overwhelming. He felt invincible. He immediately plowed that profit, and more, into the next hot stock being discussed online. He made dozens of trades in a single month. He bought options, a form of leverage he didn't fully understand. His account value swung wildly. One day he was up 20,000, the next he was down 15. He was glued to his phone, his emotions a roller coaster tied to the stock ticker. By the end of the year, after hundreds of trades, he looked at his account and was shocked to see he was only up about $5,000 in total. He had given back most of his early gains through a series of ill-timed, emotional trades, but the real disaster came in the form of a 1099-B from his broker. It was a document dozens of pages long, detailing every single one of his trades. His net gain was $5,000, but his total winning trades added up to over $50,000 in short-term capital gains. His losing trades could offset some of that, but the tax calculation was a nightmare. He ended up owing the IRS nearly $12,000 in taxes. He had a net profit of $5,000 in his account, but a tax liability of $12,000. He had managed to trade himself into a net loss, with the government being his most profitable counterparty. Kevin's story, and countless others like it, is the ultimate cautionary tale. It is the action bias weaponized by modern technology. The platform is designed to encourage activity with its confetti animations for trades and its user-friendly interface that makes complex financial transactions feel like a mobile game. This path is the antithesis of a sound investment strategy. It is pure speculation, driven by social contagion and the illusion of control. It is a world where tax efficiency is an alien concept. The result is almost always the same. A small number of lottery-like winners and a vast majority who end up with high stress, modest gains or significant losses, and a surprisingly large and complex tax bill. It is the fast lane to financial disappointment, a path that enriches only the brokers and the tax authorities. The direct financial connection of mastering the action bias is profound, and it can be measured by a single metric: portfolio turnover. Turnover is the rate at which an investor or a fund manager buys and sells assets within a portfolio. A turnover rate of 100% means that, on average, the entire portfolio is sold and replaced once every year. A turnover rate of 10% means the average holding period is 10 years. The financial impact of turnover is a triple-headed monster. First, there are the explicit costs. Even with commission-free trades, there is always the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for at any given moment. For an active trader, these small spreads add up over hundreds of trades, acting as a constant, low-grade friction that erodes returns. Second, there are the implicit costs of poor decision-making. As we've discussed, high activity is highly correlated with emotionally driven, poorly timed trades. High turnover is often a sign of a lack of conviction and a reactive, rather than proactive, strategy. But the third and most devastating cost is tax drag. A portfolio with 100% turnover is, by definition, a portfolio that is realizing all of its gains as short-term capital gains. It is a structurally tax-inefficient machine. Let's look at the real-world data. Numerous studies have compared the performance of high-turnover mutual funds to low-turnover mutual funds. Time and time again, the data shows that, on average, low-turnover funds outperform their high-turnover counterparts over the long run, especially on an after-tax basis. A fund manager who is constantly churning the portfolio is not only incurring more trading costs, but is also generating a steady stream of taxable capital gains distributions for their shareholders. This means that even if the fund's pre-tax performance looks good, the real after-tax return that the investor gets to keep is often mediocre. Warren Buffett's Berkshire Hathaway has an extremely low turnover rate. He buys businesses with the intention of holding them forever. This minimalist approach to activity has a direct and powerful effect on the company's financial performance. It minimizes frictional costs. It ensures decisions are based on long-term business fundamentals rather than short-term market sentiment, And, most critically, it creates a tax-efficient structure where capital can compound for decades without being eroded by annual tax bills. For a retail investor, tracking your own portfolio turnover can be a powerful diagnostic tool. If you find your turnover is consistently above 20 or 30%, it's a red flag. It's a sign that the action bias has taken root in your process. Lowering your turnover is one of the most direct and impactful ways to increase your real take-home after-tax returns. It is the financial manifestation of winning the inner battle against the brain's betrayal. This leads us directly to our fourth pillar, which is the strategic solution to the psychological problems we've identified. If the goal is to hold for the long term and resist the bias for action, what exactly are we holding? The answer requires a fundamental shift in identity. We must evolve from thinking like a stock trader to thinking like a business proprietor. This is the owner's blueprint. A stock trader looks at a ticker symbol, a chart, and a price. A business proprietor looks at a company's products, its position in the market, its management team, and its long-term cash-generating capabilities. A trader asks, "Where is this stock going next week?" An owner asks, "Where will this business be in 10 years?" This is not just a semantic difference. It is a complete reframing of the investment process that has profound implications for both your behavior and your tax bill. The trader's mindset is inherently short-term and leads to the high turnover, tax-inefficient behavior we've dissected. The owner's mindset is inherently long-term and naturally leads to the patient, low-turnover, tax-efficient strategy that Buffett has perfected. Adopting this blueprint is about changing the very questions you ask before you invest, which in turn changes the type of assets you are willing to own. It is the bridge from speculation to true investing, and it is the only reliable path for a retail investor to achieve superior portfolio growth over the long run. The foundational anecdote for this seismic shift in perspective is the story of Berkshire Hathaway's acquisition of See's Candies in 1972. This transaction is arguably one of the most important in Buffett's career because it marks the point where his philosophy evolved, largely thanks to the influence of his partner Charlie Munger. Prior to See's, Buffett was largely a practitioner of cigar butt investing, a strategy he learned from his mentor, Ben Graham. The idea was to find deeply undervalued companies, often mediocre businesses trading for less than their liquidation value. You'd buy them, wait for the market to recognize a small bit of value, get one last puff out of the cigar butt, and then sell to move on to the next one. This was a profitable strategy, but it was also a strategy of high turnover. It was not about owning great businesses forever. See's Candies changed everything. See's was a high-quality, family-owned chocolate company based in California. It was not a statistically cheap cigar butt. The company had a powerful, beloved brand, a loyal customer base, and significant pricing power, the ability to raise prices year after year without losing business. Munger convinced Buffett that it was better to pay a fair price for a wonderful business than a wonderful price for a fair business. A wonderful business, Munger argued, would compound its intrinsic value for decades, creating wealth far beyond what could be achieved by flipping mediocre companies. They purchased See's for $25 million. At the time, Buffett thought he was paying a premium. But their analysis was not about the stock market's valuation of See's. It was about the fundamental economics of the business itself. They analyzed the brand's strength, the loyalty of its customers, and the minimal capital required to grow. They were buying the entire company, thinking like proprietors who would have to run it for the next 50 years. And the results were astonishing. Since 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which has been sent to Omaha to be reinvested in other businesses. The initial $25 million investment has been returned 80 times over, and Berkshire still owns 100% of the thriving, profitable company. The See's Candies acquisition was a revelation for Buffett. It taught him the immense value of quality and the power of owning a business with a durable competitive advantage. It was the moment he transitioned from being a brilliant stock picker to being a legendary capital allocator. He stopped looking for cigar butts and started looking for businesses he would want to own forever. This shift in mindset, from trader to proprietor, is the very core of the owner's blueprint. It is the intellectual foundation upon which the entire modern Berkshire Hathaway empire has been built, and it is a model that any investor can and should adopt for their own asset allocation and long-term investment strategy. The underlying psychological principle at play here is the power of identity-based habits. James Clear, in his book Atomic Habits, explains that the most effective way to change your behavior is to change your self-perception. The goal is not to trade less, a behavior-based goal. The goal is to become a long-term investor, an identity-based goal. When you adopt a new identity, your behaviors start to align with that identity automatically. A person who identifies as a healthy person doesn't have to force themselves to go to the gym. It's just what a healthy person does. Similarly, an investor who truly adopts the identity of a business proprietor will find that their decision-making process changes organically. When you see yourself as a part owner of a handful of businesses, you start to care about things that a trader ignores. You read the company's annual report not as a chore, but as a letter from your business partners, the management. You view a market crash not as a personal financial crisis, but as an opportunity for your business, the company, to buy back its own shares at a discount, increasing your ownership stake. You see a dividend not as a windfall, but as your share of the profits, cash flow to which you are entitled as an owner. This identity shift changes your emotional response to market events. The trader who identifies with the daily P&L of their account is on a constant emotional roller coaster. The proprietor who identifies with the long-term success of their businesses has a much more stable, resilient emotional foundation. They are playing a different game, with a different scoreboard and a different timeline. Adopting the CEO mindset for your own portfolio is the ultimate expression of this identity shift. You are the CEO of You Inc. Your brokerage account holds the assets of your personal holding company. Your job is not to guess the whims of the market, but to make wise executive decisions about where to allocate your company's capital for the long run. Every decision to sell an asset and trigger a tax is a decision to take a distribution from your company, a move that should be made rarely and only for very good reasons. This reframing is incredibly powerful. It elevates the task of investing from a speculative hobby to a serious professional endeavor. By changing your identity, you change your actions, and by changing your actions, you build the patient, tax-efficient portfolio that leads to financial freedom. So what is the practical blueprint for making this identity shift a reality? It comes down to a specific due diligence process, a set of questions you must answer before you are allowed to purchase a single share of a stock. Let's call it the business owner's due diligence. This is not about charts or technical indicators. It is about understanding the business as if you were about to buy the whole company. Step 1. The business model brief. You must be able to write a one-paragraph summary of how the company makes money. Who are its customers? What product or service does it sell? How does it get paid? If you cannot explain this in simple terms, you have no business owning it. This is the most basic test of understanding, and it's one that many traders who buy based on a ticker symbol and a news headline would fail. Step 2. The competitive landscape analysis. You need to identify the company's main competitors. What is this company's competitive advantage, or moat, that allows it to fend them off? Is it a low-cost producer? Does it have a powerful brand? Is there a network effect? High switching costs? You must be able to articulate this advantage clearly. Then, you must consider the long-term durability of that moat. What are the biggest threats to it over the next decade? This step forces you to think not just about the company in isolation, but about its position within its entire industry. This is a critical exercise for any entrepreneur or CEO. Step 3. The management quality check. Who is running the company? You need to read the CEO's recent letters to shareholders. Do they write clearly and honestly, admitting mistakes? Or do they use jargon and blame outside factors for poor performance? You must also look at their capital allocation history. What has management done with the company's profits? Have they reinvested it wisely in high-return projects? Have they bought back shares at attractive prices? Or have they squandered it on overpriced, ego-driven acquisitions? As a part owner, you are hiring the management team to work for you. You must have confidence in their competence and integrity. Step 4. The financial health exam. You don't need to be a CPA, but you do need to understand a few key metrics from the company's financial statements. Look for a history of consistent revenue and earnings growth. Check the balance sheet for a reasonable level of debt. Look for strong and stable profit margins. Is the company consistently generating free cash flow? This is a simple health checkup to ensure you are buying a robust and resilient business, not one that is financially fragile. By diligently going through this 4-step process for every potential investment, you are forced to adopt the mindset of a business owner. It is a slow, methodical process. It is the polar opposite of the fast-paced, impulsive world of day trading. It ensures that any company that makes it into your portfolio is one that you understand deeply and have a high degree of conviction in, making it far easier to hold for the long term and reap the benefits of tax-deferred compounding. The antithesis of the owner's blueprint is the all-too-common approach of the chart watcher. This is the individual who believes that all the information they need to make an investment decision is contained within the historical price action of a stock. They are masters of technical analysis, fluent in the language of moving averages, support and resistance levels, head and shoulders patterns, and Fibonacci retracements. They know nothing and care to know nothing about the underlying business. To the chart watcher, a stock is not a piece of a company. It is an abstract pattern on a screen, a squiggly line to be deciphered. They might buy Ford Motor Company not because they have a view on the future of electric vehicles or the company's manufacturing efficiency, but because its 50-day moving average just crossed above its 200-day moving average, a golden cross pattern that signals bullish momentum. They might sell Apple not because its competitive position is eroding, but because its relative strength index, RSI, has entered overbought territory. Their decisions are based entirely on price and momentum signals, which are, by their very nature, short-term indicators. This approach is the epitome of the trader's mindset. It is a world completely divorced from the fundamentals of business. The chart watcher treats all companies as interchangeable widgets, their identities reduced to a 4-letter ticker symbol. This inevitably leads to a high turnover strategy. The signals are constantly changing, prompting frequent buying and selling. A golden cross one month can be followed by a death cross the next, triggering a rapid reversal of the position. The holding period is determined not by the long-term prospects of the business, but by the fleeting patterns on a chart. The disastrous consequence of this approach is twofold. First, it is an intellectually shallow game with a very poor long-term track record for most who play it. It provides the illusion of a sophisticated, scientific approach, but it is often just a form of financial astrology. Second, and more relevant to our discussion, it is a recipe for extreme tax inefficiency. By its very design, it is a short-term strategy. It almost exclusively generates short-term capital gains, subjecting the investor to the highest possible tax rates and the constant drag of tax payments. The chart watcher may have a few successful trades, but over a lifetime, they are playing a losing game against both the market and the IRS. They are the perfect example of someone who is renting a stock, not owning a business, and they pay a steep price for that distinction. The direct financial connection of adopting the owner's blueprint is that it fundamentally changes the composition and character of your balance sheet, whether personal or corporate. You move from a collection of speculative instruments to a portfolio of high-quality, cash-generating assets. Let's look at the balance sheet of Berkshire Hathaway for the ultimate example. When you look at Berkshire's assets, you don't just see a list of publicly traded stocks. You see a massive section labeled Insurance and Other, which includes wholly owned operating businesses like Geico, BNSF Railway, Berkshire Hathaway Energy, and Precision Castparts. These are not stocks, they are entire companies that Buffett and Munger bought outright. Their earnings flow directly into Berkshire's coffers. Then you see the equity portfolio, which includes huge long-term stakes in companies like Apple, Bank of America, and Coca-Cola. Buffett refers to these as his four giants, treating them more like controlled subsidiaries than passive investments. This structure has a profound financial benefit. The cash generated by the wholly owned businesses like See's Candies can be used to invest in the publicly traded stocks like Apple without creating any kind of taxable event for Berkshire's shareholders. The capital flows and compounds inside the corporate structure in a tax-sheltered environment. For an individual retail investor, applying this mindset means viewing your portfolio not as a single number, but as a collection of distinct business assets. Your personal balance sheet might list your home, your car, and then, under investments, you would list your stake in Microsoft Inc., Johnson & Johnson, LLC, and so on. This simple act of relabeling reinforces the ownership identity. The financial impact is that you start to value these assets based on their ability to generate earnings and dividends over the long term, not just their fluctuating market price. You become focused on the quality of the assets on your balance sheet. This leads you to favor companies with strong cash flow, low debt, and high returns on equity, the very characteristics of businesses that can be held for the long term. This strategy builds a more robust, resilient financial foundation. Your portfolio becomes less susceptible to the whims of market sentiment and more anchored to the real-world performance of the great businesses you own. It transforms your investment account from a volatile trading vehicle into a steadily compounding machine, driven by the earnings power of corporate America. This is the tangible financial outcome of the owner's blueprint: a stronger balance sheet, a more predictable stream of future income, and a dramatically more tax-efficient path to building wealth. We now arrive at our fifth and final pillar, the apotheosis of Buffett's thinking on this subject. We will explore how he took the principle of tax-efficient long-term holding and scaled it to its ultimate form, the Berkshire Hathaway corporate structure. This is not just a strategy an investor employs, it is a machine, an ecosystem, meticulously designed to be the most tax-efficient wealth compounding vehicle the world has ever seen. Understanding this structure is to understand Buffett's genius at its highest level. It elevates the conversation from personal finance and portfolio management to the realms of corporate strategy and advanced tax planning. For the individual shareholder of Berkshire Hathaway, the company itself acts as a massive tax-deferred investment account. The brilliance is how Buffett can move capital between investments, effectively rebalancing his portfolio on a colossal scale, without triggering a single penny of capital gains tax for the people who own the company. He has created a system where the default path is tax-efficient compounding, making it the perfect vehicle for any investor who subscribes to his long-term philosophy. A foundational anecdote that illuminates the power and learning curve behind this structure involves one of Buffett's biggest mistakes, the acquisition of Dexter Shoe Company in 1993. At the time, Dexter seemed like a good business with a durable moat in American-made shoes. Buffett was so confident that he purchased the company not with cash, but with Berkshire Hathaway stock, exchanging about $433 million worth of Berkshire shares for the company. This turned out to be a catastrophic error. Dexter's competitive advantage quickly evaporated in the face of cheap foreign competition, and the business's value went to effectively zero. Buffett has called this his worst deal ever, not just because the business failed, but because of how he paid for it. The Berkshire stock he used to buy a worthless company would, today, be worth over $12 billion. He effectively traded a fortune for nothing. However, this painful lesson taught him something invaluable about the Berkshire structure. While using stock was a mistake, the concept of moving capital internally was the key. He perfected this with later acquisitions. Consider this process. Berkshire's wholly owned subsidiary, See's Candies, generates, say, $100 million in profit. That cash is sent up to the parent company Berkshire Hathaway with minimal tax friction. Buffett, as the CEO of the parent company, can then take that $100 million and use it to buy shares of Apple in the open market. Notice what has happened. Capital has been moved from a 100% owned candy business into a minority stake in a technology company. For you or me to do this, we would have to sell one stock to buy another, realizing a capital gain and paying tax. But for the Berkshire shareholder, this entire reallocation of capital happens inside the corporate walls, completely tax-free from their perspective. They have effectively sold their indirect interest in See's Candy's future earnings and bought an indirect interest in Apple's future earnings without a single taxable event. The only way a Berkshire shareholder pays capital gains tax is if they sell their shares of Berkshire Hathaway itself. As long as they hold, they are a passenger in this perfectly engineered tax-deferred compounding machine. This structure allows Buffett to act as the ultimate capital allocator, harvesting cash from mature, slow-growth businesses and redeploying it into new areas with higher growth prospects, all while deferring the tax bill indefinitely for his partners, the shareholders. It is the owner's blueprint, implemented at a corporate level, a masterpiece of financial engineering designed for one purpose: maximizing long-term, after-tax returns. The underlying psychological principle that makes the Berkshire structure so brilliant is its use of defaults and system design. Behavioral science has shown that defaults are incredibly powerful. We tend to stick with the preset option, whether it's the default ringtone on our phone or the default investment option in our 401k. Most people don't change the default because it's the path of least resistance. Buffett understood this and designed a system where the default setting for shareholders is optimal long-term behavior. The default is to do nothing and let him and his team handle the capital allocation internally. The system doesn't pay a dividend. This is a crucial and deliberate choice. A dividend would force shareholders to receive cash each year, creating a taxable event for them and forcing them to make a decision about where to reinvest that cash. By retaining all earnings, Buffett removes that friction. He makes the default choice, reinvestment within the tax-efficient corporate structure, automatic. The shareholder doesn't have to do anything to have their share of the profits reinvested for them by a master capital allocator. This system design masterfully overcomes the psychological biases we've discussed. It defeats the action bias because the shareholder is not prompted to act. The reallocation happens silently and efficiently behind the scenes. It bypasses hyperbolic discounting because there is no option for an immediate, smaller cash reward, the dividend, versus the larger, long-term reward of tax-deferred compounding. The system makes the long-term choice for you. It is a form of benevolent paternalism. Buffett has essentially said to his shareholders, "Trust me to be the CEO of our collective capital. I will make the executive decisions to move our money to where it can be most productive, and I will do it in a way that defers your tax bill for as long as possible. Your only job is to remain a patient, long-term owner of this enterprise." By creating this system, he has not only built a massive company, but has also created a behavioral framework that guides hundreds of thousands of investors toward a more rational and profitable way of managing their wealth. It is a structure that aligns the interests of management and shareholders perfectly toward the single goal of maximizing long-term after-tax intrinsic value. How can a regular investor who can't create their own multi-billion-dollar holding company apply this mental model? The blueprint is to adopt the personal holding company mindset. You must learn to view your entire collection of investment accounts, your 401k, your IRA, your brokerage account, as a single entity. You, Inc. You are the chairman and CEO. The primary directive of You, Inc. is to grow its intrinsic value on a long-term, after-tax basis. This mental model has several practical implications. First, it encourages consolidation. Managing 10 different accounts is like managing 10 unruly subsidiaries. Simplifying down to a few core accounts makes it easier to see the big picture and manage your overall asset allocation. Second, it changes the way you think about transactions. Every time you sell a stock in your taxable brokerage account, you are not just taking a profit. You are forcing your holding company, You, Inc., to make a taxable distribution to its sole shareholder, you. A good CEO is reluctant to make distributions, preferring to keep capital inside the company where it can compound. This makes you view selling as a decision of last resort, to be done only when the capital is desperately needed for an external purpose, like a down payment on a house, or when an asset has fundamentally deteriorated. Third, it highlights the immense value of tax-advantaged accounts like a 401k or a Roth IRA. These are the, quote, wholly owned subsidiaries of you Inc., where capital allocation can happen completely tax-free. Inside a 401k, you can sell one fund and buy another without any immediate tax consequences. The personal holding company mindset would therefore dictate that you maximize contributions to these accounts first, as they are your most powerful tax-efficient compounding machines. Fourth, for your taxable account, it encourages you to think like Buffett does with Berkshire's equity portfolio. Your goal should be to build a collection of wonderful businesses that you can hold for decades, businesses that gush cash flow in the form of dividends. This dividend income is the cash flow for you Inc., which can then be redeployed to buy more assets, all while deferring the capital gains tax on your core holdings indefinitely. By adopting this powerful, unifying mental model, you elevate your financial planning from a series of disconnected transactions to a coherent, long-term corporate strategy. You become the Warren Buffett of your own financial life. The antithesis of the elegant, efficient Berkshire Hathaway structure is the typical, high-cost, tax-inefficient mutual fund that dominates the investment landscape for most retail investors. These funds, especially actively managed ones, are often structurally designed to work against the long-term, tax-conscious investor. Let's examine why. Most mutual funds are structured as pass-through entities. This means they are required by law to distribute any realized capital gains to their shareholders each year. Imagine a mutual fund that has held a stock for 10 years and it has appreciated enormously. Now a wave of new investors comes into the fund, and a wave of old investors decides to redeem their shares. To meet these redemptions, the fund manager is forced to sell some of that highly appreciated stock. This action triggers a massive capital gain. At the end of the year, the fund must distribute that gain to all of its shareholders, proportionally. This creates a nightmare scenario for a new investor. You could invest in a mutual fund in October, watch the fund's value go down for the next 2 months, and then in December, receive a 1099 form stating that you have a large capital gains distribution that you now owe taxes on. You have lost money on your investment, but still have a tax bill. This happens because you are inheriting the tax liabilities of the investors who sold before you. It is a fundamentally flawed structure for long-term taxable investors. Furthermore, the incentives of many fund managers are not aligned with tax efficiency. They are often judged and compensated based on their 1-year or 3-year term pre-tax performance. This encourages a short-term mindset and high portfolio turnover to chase hot sectors, with little regard for the tax consequences being passed on to the shareholders. This is in stark contrast to Buffett, whose entire compensation is tied to the long-term performance of Berkshire's book value and who is a massive shareholder himself, making him perfectly aligned with the other owners. The average mutual fund is like a leaky bucket, constantly losing water to fees and taxes. The Berkshire Hathaway structure is like a sealed vault, where capital is allowed to compound with maximum efficiency. For any serious investor focused on building wealth in a taxable account, understanding this structural difference is critical. It's why low-cost, low-turnover index funds or ETFs are often a superior choice to traditional active mutual funds, and it's why the Berkshire model stands alone as the gold standard of tax-efficient wealth management. The direct financial connection of the Berkshire structure is a concept that every sophisticated investor must understand: the leveraging of a low-cost basis. A cost basis is, simply, the original price you paid for an asset. As we've seen, when you hold a stock for decades and it appreciates significantly, your cost basis becomes a tiny fraction of its current market value. For Berkshire, its cost basis in Coca-Cola is $1.3 billion, while the market value is $25 billion. The tax liability is tied to this massive gap. A sale would be a financial earthquake. But here is the ultimate masterstroke of financial planning for the ultra-wealthy. And it's a strategy that Buffett has perfected. You can access the value of your assets without ever selling them. How? By borrowing against them. An individual with a $25 billion portfolio of Coca-Cola stock can go to a bank and get a loan for, say, $1 billion at a very low interest rate, using the stock as collateral. A loan is not income, so it is not a taxable event. The investor gets the cash they need, and the stock portfolio remains intact, continuing to appreciate and pay dividends, which can be used to service the loan interest. Buffett does this on a corporate scale. Berkshire's massive portfolio of stocks and its fortress balance sheet give it the ability to borrow money at incredibly cheap rates or issue its own debt. This allows him to access liquidity when he needs it for a major acquisition, without having to sell his core holdings and trigger a massive tax event. He can essentially have his cake and eat it too. This strategy of buy, borrow, die is a cornerstone of generational wealth management. The idea is to hold appreciating assets your entire life, borrow against them for liquidity, and then, upon death, your heirs receive the assets with a stepped-up cost basis. This means their cost basis is reset to the market value of the asset on the date of death, effectively erasing the lifetime of capital gains from the tax books forever. While laws can change, this principle of using a low-cost basis as a source of borrowing power is a direct and profound financial advantage derived from a lifetime of long-term holding. It is the final, ultimate reward for defeating the action bias, embracing the owner's mindset, and patiently allowing your capital to compound in a tax-efficient machine. It is the pinnacle of the Buffett strategy to not just grow your profits, but to keep them and put them to work for generations to come. You have just absorbed a complete framework for one of the most powerful wealth-building engines ever created. You now see the market not as a casino of flashing lights and frantic action, but as a venue for partnering with great businesses. You understand the invisible, relentless thief of tax drag, and you now possess the mathematical and psychological tools to defeat it. You have moved beyond the amateur's obsession with pre-tax gains, and have graduated to the professional's focus on the only number that truly matters, your after-tax return. This knowledge is a permanent upgrade to your financial operating system. The ability to distinguish between activity and achievement, to embrace patience as a weapon, and to think like an owner, not a trader, is a mental tool that can quite literally change your financial destiny. But what you've mastered today is a single crucial pillar in a much larger architecture. Buffett's system for wealth creation is not a collection of isolated tips. It is a network of interconnected mental models. Mastering tax efficiency is like building an impregnable fortress. It is a defensive masterpiece that protects your capital and allows it to compound without interference. However, a fortress, no matter how strong, is useless without a powerful army to project its power. The question that logically follows is, how do you identify the wonderful businesses that are worthy of being protected inside this fortress for decades? What are the specific qualitative and quantitative traits that Buffett looks for? That is the offensive strategy. It is the other half of the equation. The video that is now appearing on your screen is the next piece of the map. It is the crucial link that connects the defensive strategy of tax efficiency you've just mastered with the powerful offensive strategy of superior business selection. It takes you inside the mind of the capital allocator, revealing the checklist he uses to separate the temporary winners from the permanent powerhouses. You have built the vault. The next step is to learn how to fill it with treasure. You have made an incredible investment of your time today to move from the 99% to the 1% in terms of financial thinking. The question now is whether you will complete the journey. The choice to continue is not about watching another video. It is a choice about your own identity. It is for those who are no longer content to be mere retail investors, but are committed to becoming true architects of their own wealth. The link to completing your mental arsenal is right there on the screen. Continue your ascent,